Ladies and gentlemen, good evening. This is Christopher Aaron. It is the 29th of March, 2017. I do thank you for being with me. There is a lot to discuss tonight, a lot going on with the gold and the silver markets. There are some major actions happening in the US dollar, and I also want to go over what is happening with the gold miners. There's been some underperformance in the gold miners recently. I want to cover it and put it into better perspective. I think this is a really important time period that we are living through. I think books will be written about this time period, both from the political sense and also the economic sense. And I'm glad that you're here with me today, and I want to go through this because I think this is such a big opportunity that is setting up, but it's going to be so hard to really stay focused on it because it is so violent. So that is the point of this channel, just to show us exactly what is happening in the markets as we go along. Starting off tonight in our normal format, looking at the prices of spot gold. We can see it's been relatively steady for the last few days, coming up to a resistance point that I was anticipating. Premium subscribers have known about that. I've had this 1265 level labeled as a minor short-term resistance. We're seeing a little bit of weakness here into the beginning of the Asian hours on Thursday. I am not very concerned about gold or silver at all over the short run. I think there's a range that these metals are going to be in. Let's switch over to silver. As we see, silver has been relatively stronger than gold, which is a good sign for the entire precious metals complex. We have to keep data points such as this in the back of our minds all the time, even as we're looking at things like what we'll look at soon, which is the miners underperforming. We have to keep in mind when we see silver outperforming gold, it's telling you that something good is happening in the entire complex here. Okay, so this is more of a big picture type of data point to keep in the back of your mind. Let's switch over. Now, this is the big topic that I wanted to discuss today, the US dollar. If you go back a few videos ago, we were talking about the potential for a breakdown here in the US dollar. I just want to fill everyone in on what I was talking about back then, and we'll update on the scenario right now. Now, the dollar is so important because over the short and the intermediate run, I would say anything from a few weeks up to a couple of year time frame, the dollar really has a huge impact on the price of the precious metals. You know, the precious metals are priced in dollars. And furthermore, if you really think about it from a broad perspective, the dollar is the world's reserve currency at this point. And the single asset class that stands in opposition to the dollar, it's not the euro, it's not the British pound, it's not the Swiss franc, it is gold. So there's this battle going on underneath the scenes between the dollar and gold at this time. So you can see here when we're talking about this, the chart of the dollar, since 2014, you had this major rise in the dollar from 79 up to around 100. And then from the beginning of 2015, you had this back and forth consolidation here in the dollar for just about 2 years, between 92 and just over 100 on the dollar index. So then in the wake of the Trump victory, you had this breakout here, which we've labeled the breakout in the dollar above 100 on the dollar index. And then, of course, you had a retest coming right back down to this level, a nice bounce. Everything looked fine from a technical standpoint. It looked as if the dollar was going to continue advancing very strongly. But something happened here which started to alert me back in late December, early January, that something is not right here in the dollar. So we saw this next surge stall out at about 103, 103.5 on the index. And the dollar came right back down to this same low here, right around 99.5. Actually briefly spiked lower than that. But the point is here that if you have a breakout and then a new high, you really shouldn't have a second retest coming back down to the same level as the first retest. On a breakout like this, after a 2-year consolidation, you should have, if you have one retest, you should then have a real surge and a sustained move higher. And this is not what we saw. So after that in the dollar, you had this kind of weak bounce right here. And I started to get this idea that there was this head and shoulders top formation here in the dollar. You can see it right here. A larger head and two shoulders on each side. Now this is a reversal formation, all things considered. Now what we saw on Sunday night in Asia just this week was a break, again, a new low in the dollar below this 99.5 level right here where the bouncing ball is. So the dollar is on the brink right now. This is a very precarious point, and if you are investing in the precious metals or the mining sector, or really any of the commodities for that matter, this is going to have such an important determination on what happens to these markets over the course of the next several years, perhaps even well into the next decade. We could be watching the turning point here right in front of our eyes. So it's such a tight situation here from a technical standpoint. You basically saw a break of this 99.5 level. We've come back up in the dollar today to just above 100. But I think what you are seeing is the dollar making its final gasp here. I do not think the dollar will recover the upper portion of this resistance zone here labeled just below 101. Now there is a rising trend line. We can see this in blue. It is no doubt that this is why the dollar bounced at this level. Look at the hits on this rising blue trend line. So if anyone is telling you that the actions in these markets are random, you can very plainly see that that is not the case. So what do I expect for the dollar right now? It's sandwiched in between trying to break down from a multi-year top and this sort of primary 9-month rising trend right now. It's sandwiched right in between that. This is such a critical thing to be monitoring here. My take on the dollar is that what we are going to see is something like a little bit of a weak bounce here and perhaps some grinding right below 100, right below 101 in this region of the resistance zone. And then very quickly, at some point in the next week to 2 to 3 weeks, we're going to see, boom, a smash down below this rising support level here, fulfilling this head and shoulders pattern. Now from that point on, we're going to have to take a look at some longer term charts. I think this top that we're seeing right here could be the 16-year cyclical top in the dollar. The last top in the dollar occurred exactly 16 years ago at this level. I think we are seeing a very similar formation happen right now. And if so, this head and shoulders top was the top of the 16-year cyclical high. Very, very important to follow this over the course of the next couple weeks and definitely through the summer. Turning the attention to the gold miners versus gold. Let's bring this up. So I've received a lot of emails, a lot of messages regarding the action in the gold miners. As you know, I think there's a lot of merit to owning high quality gold and silver mining companies at this juncture in the cycle. I own quite a few myself. I've advised a number of people on constructing portfolios that should capture the move that I anticipate. Now, just as a backdrop, I also own a significant amount of physical gold and silver. So keep in mind as a backdrop, when I'm talking about this, I'm never making an all or nothing statement. Furthermore, I do not have all of my capital in the precious metals. Okay, I have some money, as strange as it sounds, just sitting in US dollars in a short-term savings account. But I am here talking about the relationship between the gold mining complex and gold. These two things are intrinsically related, right? You have the gold, the metal that comes out of the ground, and then you have the companies that actually dig it out of the ground. So you can see there obviously should be some relationship between the valuation of these two. And it is typical that the gold mining equities move in a leveraged manner to the price of the metal itself. For example, if the metal itself rises 10%, it's not uncommon to see the large cap gold miners, as we're looking at here with the GDX fund, to move higher by 20 or 30%. That's in general. Now, something strange has been happening over the course of the last 2 months. We're looking from mid-January through the present. We have the gold miners, the GDX fund on the top, and the price of gold represented by the GLD fund on the bottom. So you can very clearly see that the GLD fund representing the price of gold here has just about come up to match the high from late February, whereas the gold mining complex is well below the high from late February. So we can see, and I've gotten a lot of messages on this. If you have sent me a message on this, know that you are not the only one. You're not the person that I'm talking about. I'm in this industry. I connect with a lot of people, from mining companies to other letter writers, to article writers, and we're all talking about this same thing right now. So this is very evident on the charts, the underperformance in the gold mining complex over the short run. So it's very important, if you are going to be investing in the gold miners, to understand that the outperformance does not work across all timescales. There are going to be periods like this where, if you're holding the GDX or you're holding the individual strong gold and silver mining companies, you will underperform the metal itself. This is why I always recommend a dual policy. Stack the metals on a regular basis, and then make good leveraged long-term investments in the gold mining equities. We were talking about this last week with Francis Hunt, and it's a policy I really agree with. Stacking the metals and making good targeted investments here in the gold mining sector. Now, let's put this into perspective, because I think the sentiment has gotten a little bit out of hand at this point. I think there's a little bit too much fear for what we are actually talking about here in the sector. So I want to do something a little different. This is now the ratio. We were just looking top gold miners, bottom price of gold. We are now looking at the same thing. This is the different index of gold miners. This is the XAU index. And we're looking at the price of gold as a ratio format. So one divided by the other. In other words, how many ounces of gold does it take to buy one share in the top 30 gold and silver mining companies in the world? So when this is going down, what we're seeing is that the gold miners are losing value relative to the price of gold itself. The gold miners, as we have seen, are underperforming by 11% over the last month and a half. So this is what's gotten a lot of people frustrated, a little bit worried, and rightfully so over the short run. Don't get me wrong. But I want to put this in better perspective, because I think there is such a critical opportunity setting up here in this sector. I think this is going to change lives when you look back at this from a 3 to a 5, even a 10-year time perspective. But you really have to not get too lost in the short run at this point. So we're going to back this ratio chart out, as we typically do. We zoom it out to a year and a half. We were just looking at this. This was the underperformance in the gold mining complex relative to the price of gold that we were looking at right here. Keep in mind that from the bottom, the 2016 bottom, the gold miners have outperformed the price of gold by 54%. So here's the data right here. It really depends on the time frame that you are talking about. Now, many people were not buying gold miners here in the beginning of 2016. And that's why there's a lot of frustration, I think, in this sector right now. Most people didn't become interested in this, until sometime here in June, July, August. And so a lot of people are sitting on losses over the short run. I want to put this into better perspective. There is a real significant opportunity, but it's not going to come easy. It's not going to be easy for us all to stay in this sector. Let's back this out again. Again, gold miners versus the price of gold itself. This was the last chart we were looking at. Now we're going back from the previous highs in gold and silver. The previous high was actually here in 2011. We're talking about gold at $1,900 and silver at $50. But the high in the ratio was actually here at the later part of 2009, early 2010. Since then, the gold miners, even including this bounce that we've seen since 2016, the gold miners have lost 62% of their value relative to the price of gold. So it has been an absolutely abysmal time to be a gold mining investor basically for the last 6 years, except for this last year. Now, not to toot my own horn, well, maybe I will toot it just a little bit, but there is a reason why I started my premium service. If you're a subscriber, you can go back, you can look at the first date of the first issue that came out. When was it? Right in the middle of February 2016. Okay, so right here. There was a reason why I started it at this time, not because I have a crystal ball, not because I know everything, but I was looking at this chart, and we'll back it out one more time. I was looking at this chart, and I was saying, this is the cheapest that the gold miners have ever been. In the history of record keeping that we have for the gold mining index, the XAU, versus the price of gold itself, this was the cheapest they had ever been. Now, it turned out to be right. I have a few articles that I wrote at that time. I stand by that call. I do not think this low will ever be matched again. I don't think you'll ever have quite that buying opportunity again. However, I want to put this in perspective. For those of you who maybe have bought mid last year and are still sitting on some modest losses here, here's the opportunity that is setting up. Again, this is the last chart we were looking at of the XAU to gold ratio. We are looking at something, a ratio here between the gold miners and the price of gold that has fallen a staggering 90%. The valuation of the gold miners have fallen 90% versus the price of the metal itself in the last 20 years. Just let that sink in for a minute. So what we're talking about here, when we look at this time period, 2014, 2015, 2016, 2017, this is the cheapest that it has ever been to buy gold miners, basically in the history of gold mining. So if you're a contrarian, and you must be, if you're listening to this video and you're already interested in gold or gold mining, you're not doing it because you're following the advice of your job's 401k planner who is telling you to invest, in a broad stock market index. Or you're not going out there and you're not putting all your savings into US dollars. You're looking at gold, you're looking at silver, you may be looking at the gold miners for a reason. And that reason is because you're a contrarian. You're looking at the things that other people are not looking at. Well, now you have to dig a little bit deeper. Okay, so guys, this is the cheapest that the gold miners have ever been, basically, over the last couple of years, relative to the price of gold itself. And this is so important. I want to show you what the potential is here for the miners, given the following facts. This ratio cannot go to zero. Okay, and you can see the rate at which this was declining look from here, 16, 14, 12, 10, 8. This ratio is basically losing 4/100ths of a percentage point per year. At the rate it was going, this would have been 0 by the beginning of 2018. Coming up now. This ratio cannot go to 0. Why? Because it means gold in the ground would be free. It basically would mean that the first time in human history ever has arrived in which gold mining companies have all gone bankrupt. Okay, so that's an impossibility, and you have gotten the closest to an impossibility that we have ever seen. As a contrarian, this is a pretty good time to be making purchases in the grand scheme of things. Once again, closest the ratio has ever been to 0. As a contrarian, we are still much closer to the bottom here than to a peak valuation for the gold mining companies. So where do I think this is going? This is the same chart now, and we're extending this into the future. You basically had what happened over the last few years was what I would call an inverse bubble form in the valuation of the gold miners relative to the price of gold. And we can see that this was unsustainable. We had this terminal bottoming wedge pattern here. We've looked at this on so many different charts that the bottoms of long-term trends correspond typically with these wedge formations. You can see the breakout here right there when I started making the premium publication, Precious Metals Intelligence. This is the bounce that we've had so far. But this is still, if you look at it from a big picture perspective, this is still significantly below the historic normal valuation range for the gold miners relative to the price of gold. Now, it took this ratio 8 years basically to get from the lower end of the range here in 2008 down to 2016, down to the bubble, the inverse bubble valuation here. I think it's going to take something like an equivalent 8 years in a sort of 2 steps forward, 1 step back type of trajectory to get back to just the normal valuation here. And what are we talking about with that? We're talking about, for example, if the price of gold were to not change at all from the current levels near 1250, what would have to happen for the average gold mining company, not the best ones, but the average ones, to get back to about 30 years worth of historical data? What would have to happen is a 300% increase in the price of the average gold mining company. Now, you could say, well, something has changed here, and gold miners are, they've struggled with their cash costs. They've been issuing excessive shares or something like this over the last few years. And I would agree with you partially. But that should be offset by the price increase in the metal itself. And we're still talking about gold that is well over $1,000 an ounce. Whereas back in this range here, at the peak of the miner valuation relative to the price of gold, you were looking at gold that was about $300 to $350 an ounce. So there is an inverse bubble that is formed here in the valuation of the companies that are mining for gold. And I think the opposite effect is about to start taking place. So the point of this, guys, the takeaway, I know this has been a fairly in-depth video here. The takeaway of this is that if you bought, or you're looking at buying gold mining companies here in the last 6 months, and you've seen, a 20 or 30% decrease in the value of your companies as gold has been sort of range bound, floundering around 1200, 1250, you haven't seen anything yet. This surge that we saw from the beginning of 2016 through August of last year is the very warm-up of what is going to happen when we begin to enter a true bull market. And the only difference between this bull market that is setting up here with the gold mining companies and with gold compared to, let's say, a bull market in stocks is that this bull market is going to be driven by the only thing that is more powerful than greed, and that is fear. And what is it going to be fear about? It is going to be fear over a declining value in the US dollar. And I think we are seeing the very beginning of that now. I think the formation that is forming in the US dollar index that we looked at is the very beginning of a long-term top for the US dollar. And I think we're going to see a significant movement based on fear into gold. And if you are interested in gold, you've got to take a look at that chart of the relative valuation and say, is there not some merit for a long-term ownership of a portion of your precious metals portfolio in the gold and silver miners? Now, I do not work for the gold and silver mining industry. I publish the best research of the companies that I believe are going to, over the next few years, vastly outperform those indices that we were looking at. The GDX, which contains about 50 companies, and the XAU, which contains about 30 companies. I like to focus in on the companies that are showing specific patterns that I believe over the next few years are going to vastly outperform. This does not mean that they're going to skyrocket in 2 to 4 weeks or even 2 to 4 months. But when you really understand the ramifications for what is setting up in this sector, that is what I'm trying to provide. If you have a unique situation and you would like to discuss it, I do offer one-on-one consultations where I can review your situation and offer an independent perspective. Thank you very much for watching. I will see you this time next week.